So let me now introduce you to a few things in this video. First, it's the reason why those who make less than 10K do not require any type of tax filing. 2, the different types of deductions. And 3, a realm that I speak of here and there, such as the fact that in order for an express trust to claim credits, filing a return is not a prerequisite. And these information are going to be derived directly from the horse's mouth. Some credits are refundable. They can give you money back even if you don't owe any taxes. When you hear certain people from certain socioeconomic status tell you that they never rest and that they believe in hard work, the interpretation of that based on the meaning and the intent behind it is completely different than what someone else who is still in certain stages of development would mean when they say the exact same thing. When someone who is well off, someone who is wealthy, not rich, not just being able to pay their bills without worrying about stress. I'm talking about well off. Their children, if they decide they don't have to work, won't. When they tell you that they wake up every day, work hard because they love to, the reason is because of the love that they have in working, because they realize that there's only so much hour in the day. The majority of it is spent, which are necessary, like rest, personal care, basically fixing things up here and there from the previous days. So the rest of that time where they spend working is because they realize how money works and that they can maximize the opportunity to continuously grow. They already mastered the art of making monies while they're resting. They already know that, but they know that there are certain mechanisms that has to be enforced in order to increase that, so that the next time they go and rest, the amount of passive cash flow coming in would have multiplied from the previous month. That's why those types of people wake up and work hard, and they will tell you that's important. On the other hand, someone who is not quite there yet, waking up and working hard, the necessity of it is for the purpose of survival. Most are still in survival stages because they've yet to realize the system actually exists to benefit you. No particular system is perfect. Whether you look at all the isms, capitalism, socialism, whatever it is you look at, none of it is perfect. They all came by during a certain stage of development of humans as a society at large to fix a particular problem. None of it is perfect. They all came by during a certain stage of development of humans as a society at large to fix a particular problem. But humans have the tendency to go on the end of the extremes by mental lethargy. They forget about what's important, and thus those who know how to take advantage of humans. No different than when you're in the wild, you turn your back against some type of feline, have the tendency to want to run after you and chase you because they see you as vulnerable. Humans have that animal impulse too. So when certain systems have done its job, and the people who fought and died for it generation after the other start to get relaxed, well, there are those who will take advantage of that and turn it into what it's not. Such is what we're looking at in the realm of employment and monies. While there's on one hand those who comprehend how money works and they're using it to their advantage, there are those who basically are a victim to it. But those who are a victim to how money works often want to blame those who know how money works. When in truth, those who know how money works have simply kept the mental activity on getting a relationship with money and knowing how it works, and they pass it on generationally. Whereas those who point fingers and play victim never did. They lost track of the importance of how certain things work. In this case, money. I'm here to tell you, do not play victim. Be competent about how the world works. And you'll start to realize that you actually have a common enemy as those who know how money work. Because at the end of the day, those who know how money work don't want to qualify for taxes. Just as the everyday average man knows that tax is screwing them up. And if only they just knew how not to qualify for it. In this case, earned income taxes, which we spoke about in this webinar, posted as of recent on Patreon, and likely to be removed pretty soon. Competence is the key to any form of success in life. And as you go through your stages of development, those same stages of development would help you realize the importance of competence. So let me now introduce you to a few things in this video. First, it's the reason why those who make less than 10K do not require any type of tax filing. 2, the different types of deductions. And 3, a realm that I speak of here and there, such as the fact that in order for an express trust to claim credits, filing a return is not a prerequisite, and maybe 1 or 2 more points. And these information are going to be derived directly from the horse's mouth. I iterate this and like to reiterate it as much as I can. What most people are afraid of, the reason why entities like IRS grasp onto so many people's heart with fear is because they do things with impunity. And the reason why entities who screw people over do things with impunity is because they do provide people disclosure of how things work. Whether or not the everyday man or woman consciously realizes this or not is another issue, because the conscious mind is a conductor of the subconscious. And while this may seem like a left brain logic type of intelligence, believe it or not, it plays a huge role in human nature. And human nature constitutes of the use of subtleties, impulses, habits, which is your preconscious mind. And habits crystallize into circumstance, and circumstance turn into your lifestyle. Most people want the lifestyle of ease, but they don't have the habits. They don't have the habits because they don't know the reality exists consciously for them to put it to use. irs.gov/credit-and-deductions-for-individuals. Credits and deductions for individuals. How they work. You can claim credits and deductions when you file your tax return to lower your taxes. Make sure you get all credits and deductions you qualify for. It's giving you 2 different dichotomies, credits and deductions. Credits is after the tax has been determined, meaning net, and then what can be given back to you to reduce that taxable amount. Deduction is before the tax is calculated, meaning gross, so that whatever can even be decided to be taken out as tax will be automatically reduced. So say you make 300K this year. Deductions is basically, deduct the taxable amount, which is the gross, down to about 150K, so that 150K is only what's going to exist on a piece of paper as what's taxable, rather than the extra 150K making a total of 300K that you really made. That's how deduction works. Credit is, okay, you made 300K, therefore we're going to tax 40% of that. And whatever that 40% is, you now get credit to reduce it. It goes on to say, if you have qualified dependents, you may be eligible for certain credits and deductions. Claim credits. A credit is an amount you subtract from the taxes you owe. This can lower your tax payment or increase your refund. Listen to this. Some credits are refundable. Some credits are refundable. It elaborates by stating they can give you money back even if you don't owe any taxes. Some credits can give you money back even if you don't owe any taxes. The part they won't tell you about is, for the most part, the ones that qualify are trusts to do it this way. You don't have to show and snitch on yourself to say I made this much for you to gain tax credit. Because remember, we use debt instrument. And debt and taxes go hand in hand. The reason why the US bill can be taxed is because it's someone else's instrument that people are using as a debt to say, hey, give me this phone, then I give you an IOU. Therefore, the one who originally owns that IOU can tax you for using their IOU. It's called interest on money. That's what tax is. But when you function with trust, you can gain credit without first reporting the liability of taxation. If this is your first time hearing that explanation, it might resonate with you in a manner that says, that makes sense. But I really want you to stop and do some self-reflection on that. rather than merely just feeling like it means something. So take your time, reflect on these things, because it's the substance of the stepping stone for you to get to a point where you don't have to wake up and sacrifice your time for some limited monies that someone else has determined your time and life is worth. Going to sleep just to spend the energy preserved during the rest on someone else's establishment just so they could get screwed over, get taxed by the dollar, earning, sales, use taxes. Those distractions prevent education. So the time you're spending listening to this, do yourself a grand favor and just do some self-reflection on it. It goes on to say to claim credits, answer questions in your tax filing software. Remember that video thumbnail just shown previously? We explained the fact that most of them just use software. In other business 101 and trust 101 videos, I always reiterate, they just use software, click boxes and things like that. It's not as special as you think it is. If you file paper return, you need to complete a form and attach it. Those forms, if you were to do it physically, are standardized into the softwares that's used if done electronically. So it just explains to you how credits work, whether you're doing it with or without a trust, which is what I'm here to point out to you as to the distinction that would not be written on pen and paper. In other words, what's in between the lines. Now it speaks of deductions. Take deductions. A deduction is an amount you subtract from your income, meaning your gross, when you file so you don't pay taxes on it. A deduction is an amount you subtract from your income when you file so you don't pay taxes on it. Meaning before the taxes are even calculated, you just remove that taxable amount in the first place, so that any given amount that you made is not even considered as being taxable in the first instance. That's what we showed in that video thumbnail when it comes to making all your monies at work. By lowering your income, deductions lower your taxes to the base amount. You need documents to show expenses or losses you want to deduct. Your tax software will calculate deductions for you and enter them in the right forms. If you file a paper return, your deductions go on Form 1040 and may require extra forms. These may require extra forms are the stuff they're not going to clearly tell you. One of them is the Schedule A form. In another video, I've clarified the schedule forms are the forms you use to deduct things. That is if you don't choose to change the accounting method completely from the start. The reason why the assumption exists that it can even be taxed is because the accounting method is already one way, which is where the advantage of getting the source QSIP and getting access to the master file to alter the tax status on IRS level. And on that note of changing quote unquote status, what people don't realize is there are different types of statuses. So when people do things like the secure party creditor, they think it's just a one size fit all thing and everything just works and I don't have to pay and you can't arrest me anymore. In all cases, I have to be dismissed and things like that. No, all contractor specific. Can't say because now you're physically immaculate because you've worked on it. As a female, you do a lot of yoga, you do a lot of running, or a man, you work out quite often, you do intermittent fasting and whatnot. Doesn't mean you're going to have a good personality. Doesn't mean you're going to have the financial stability you require. Doesn't mean other aspects of your life are going to be good. That plays a role in giving you better chances to merge things together, but one size does not fit all. All laws are specific, and the contract makes the law. So there's different types of statuses. If you want to change tax status, you have to deal with that with the Commissioner of Commerce and that of IRS. If you want to change other aspect of reality, you have to deal with that specific angle of things. But the foundation you will be approaching it from is always the trust, because they all function through trust. And IRS is an agency of a trust called the United States, which is a sole court. And an inferior essence cannot speak with a superior one and expect it to bend to its will. A serf cannot speak to the sovereign in equal capacity. No different than when we use electricity within our technological luxury. We can't bend it to our will. We have to apply its laws and merge ourselves with it so we can put it to use. Many people refuse to accept that basic reality. I implore you to be otherwise. You be different. You think a bit different. Now to the different types of deductions. Now, by the way, there are different types of credit. They just didn't go into it, but they give you a clue as to it, because the different types of credit, if you're starting to speak about it, you have no other choice but to go into trust. And you see why trust don't have to qualify for assessment or file returns to snitch on themselves before claiming those credits. But the ones that usually generally apply to a lot of people are deductions. Now they go into different types: standardized versus itemized deductions. Most people take standard deductions, which lets you subtract a set amount from your income based on your filing status. If your deductible expenses and losses are more than a standard deduction, you can save money by deducting them one by one from your income itemizing. Meaning, if you're doing standard deductions, there's a limit on the amount of deductions that can be taken. But if you want to surpass that limitation, you must use itemized deduction, which is the scheduled forms. Again, if your deductible expenses and losses are more than the standard deductions, this is automatically telling you they're standard deductions. One of the examples of standard deduction is what you see when you look at tax brackets. You make 100K, well, this is the amount that's minimally taken away from you if you're single, if you're claiming married, separated, if you're claiming 2 children. There's a limitation on the taxable amount. There's a limitation on how much you can claim based on your tax bracket. That's if you even qualify for that. But no one ever said you can't do more than remove yourself from those boxes called tax bracket and limitation of deductions that goes along with it. Therefore, they tell you you can save money by deducting them one by one from your income, aka itemizing, if your deductible expenses and losses are more than the standard deduction. That's what's in between the line here. It goes on to say tax softwares can walk you through your expenses and losses to show the options that give you the lowest taxes, which is the luxury that accountants have, because the software basically gives them all the jewels in front of them without them having to go through all the tax codes, which they usually won't tell you because they're not obligated to unless you have a very good personal relationship with them. And the way you build a good personal relationship with those who have certain things that would assist you is for you to build your competence so that the base level of conversation will get them to open up about certain things. Because none of them will come out here and start making these videos. Even if you look at some accounts on YouTube, all they're going to do is just throw you some bones somewhere and not go through it word for word and show you the subtleties like we're doing here in other videos. Some people, including non-residents and partial year filers, can take the standard deduction amount. So they go ahead and tell you the maximum amount you can claim based on whether you're single or married, filing separately, is a little under 14K. They go and tell you if you're a married couple filing jointly or qualified surviving spouse, the limitation of the amount you can deduct is a little under 28K. If you're the head of the household, the maximum amount you can deduct is a little under 21K. The reason why those who make less than 10K are not qualified for taxes is because the lowest amount that can be deducted is over 10K. The reason why those who make less than 10K are not qualified for taxes is because the lowest amount that can be deducted is over 10K. The reason why those who make less than 10K are not qualified for taxes is because the lowest amount that can be deducted is over 10K. That's the little unspoken secret there. So for those who work maybe per diem in one job, and your CPA tells you, well, if you're making less than 10K, you don't have to file taxes, it's because the minimum amount that can be deducted is over that amount. And then they have special cases of deductions. If you're over 65 and you're blind, meaning you're disabled and you're senior citizens, you're dependent on someone else's tax return, you have your own particular type of deduction. I believe this is in publication 501. For those who are dependent and being claimed by others. And also publication 501 is for those who are senior citizens and are disabled, aka 65 or blind. And then there are other types of deductions. which is another reason why I'm making this video. Do you know if you're paying alimony or child support? Did your accountant or that courthouse tell you that you can actually deduct it as an expense? The reason why they deal with people with impunity in this system is because they give you disclosures you can do certain things. So you sign a prenuptial agreement with a woman and it ended up not going well, or La La Land, if you're the woman and you're extremely wealthy and the man somehow got you with alimony, well, you can deduct it as an expense. Business use of your car, this is quite common. I make posts on how this works. And I think this is in IRS topic 510. And this alimony part is in topic 452. And then other deduction is business use of your home, which is in topic 509. Now this fourth part, money you put in your IRA. Do you know that if you remove any amount early in your IRA, or even when you are 59, which is the generally accepted age to which you can take it out, do you know they will still tax you? And do you know that you will still get penalties and fees? And more importantly, do you know you can actually deduct it as expense? Yep, you can deduct it. And right here, penalties and early withdrawals from savings, student loan interest, teacher's expense, blah, blah, blah. And by the way, this teacher's expense is considered as educational expense. So if you have an educational company where you teach people certain things, you can do this also. And that's done in 1040 forms also. And then when you do itemized deductions, you can deduct back debts, which this is what companies do if you owe them and you don't pay. Cancel debt on home, capital losses, donation to charity, which is the one we went over in that video thumbnail just shown when it comes to work. Donation to charity. It's an itemized deduction. Home mortgage interest, sales and real estate property, disaster, theft, medical, blah, blah, blah. This world is vast, people. The importance and necessity to know how that vastness benefits you rather than you just being a drop in it and to feel powerless. You overcome that with competence. The information is out here for people. Yes, sometimes you may read it and not realize what even applies to you, and you may need to learn how to read it between the lines. But nonetheless, the information is out here available to you. Till next time, take care. Best of luck.